Hello everyone and welcome to Managerial Accounting. In this video we're going to start going over chapter 22 for budgeting. Budgeting is a very important topic because it relates to every single organization. So profit-seeking organizations like any manufacturing, merchandising business would need to set a budget. And also non-for-profit organizations, things like the government or charitable organizations, they all need to have a budget. So I think this is an important chapter to learn and understand. One thing I want to warn you about is that it's a little bit conceptual. There's a lot of terminologies that we have to learn and make sure that we understand. But at the end, I think it's very simple and most of the topics are common sense. So the first thing that we want to start with is to speak about budget. So as it says here, budgets play an important role for organizations of all sizes and forms, as I just mentioned earlier. So budgeting involves establishing specific goals, executing plans to achieve the goals, and periodically comparing actual results with the goals. So we have to set the goals, implement them, and then compare our actual results with the goals. So budgeting also affects all four of the following management process functions. So things like strategic planning, measurement, evaluation, and control. So let's speak about each one of these. In regards to strategic planning involves setting goals to guide management decisions. Measurement, on the other end, involves quantifying how well the company is achieving its goals. So we set the plans, that's the strategic planning, and the word strategic is long-term, and then we start measuring our performance. And then we evaluate later on. So evaluation involves monitoring operations by comparing actual and expected results. So basically, the expected was during the planning stage, and then we did the measurement, and then evaluation, we compare the plans to our measures. And then the fourth item here is control. And control involves taking actions to encourage specific behaviors or meet budgeted goals. There's something called participative budgeting, and from the name participative, it encourages everybody to participate with their opinions. And of course, this is not going to be random opinion, it's just based on experience. So when participative budgeting is used, employees work with their supervisors to develop performance matrices and budgeted goals. Sometimes we call it performance targets. A budgetary unit of a company called a responsibility center is led by a manager who has the authority and responsibility for achieving the center's goals. Now let's talk about the human behavior and budgeting. Human behavior has an important impact on budgeting because, again, depending on the intention, sometimes budgeting or the budget can be impacted. Sometimes we can set the budget too high, sometimes it's too low, and sometimes we have different interests, or there's what we call a conflict of interest. And all these kind of human factors or behaviors can impact the budget. So human behavior problems can arise in the budgeting process in the following situations. And here we have three examples. So budgeted goals are set too high, and sometimes it happens, like managers, they set the budget too high. It's very hard to implement. It's almost impossible to achieve. On the other end, it could be the budget goals are set to be too loose, which are very easy to achieve. So in other words, it's useless. And what also can happen is that budgeted goals conflict with the objectives of the company and employees, because managers sometimes they set the budget in a way where they can receive their bonuses, for example. So they can achieve the targets and get their bonuses, and they don't care too much about the profitability of the business. So employees and managers may become discouraged if budgeted goals are set too high, and that's very dangerous. When the budget is set to be extremely high to the point that it's impossible to achieve, again, it's very demotivating. Also, reasonable, attainable goals are more likely to motivate employees and managers. So we have to think that the budget need to be reasonable, it should be attainable, something that will motivate the employees and the managers to try to work hard to achieve these kind of goals and targets. So involving employees in the budgeting process provides them with a sense of control and therefore more of a commitment in meeting budgeted goals. When you know that your manager is the one who set the goals and you just have to follow it, sometimes you're not too excited about achieving the goal. But if you know that you were part of the group of people who set the budget and you were like discussing this budget and you were involved in the decision, that would motivate you as an employee to achieve this budget and you feel like it's attainable because I was part of the decision making here. So, although it's desirable to establish attainable goals, it's undesirable to plan budget goals that are too easy. So when you set the bar too low, that's useless. So budget padding, as it's called sometimes, or it's termed budgetary slack, is that situation. So managers may plan slack in their budget to provide a cushion for unexpected events sometimes. And again, we have to be careful about that. However, slack budgets may create inefficiency by reducing the budgetary incentive to trim spending. Goal conflict also can happen. So goal conflict occurs when the employees or manager's self-interest differ from the company's objectives or goals. And again, I gave you a simple example about achieving our bonuses or getting our bonuses by reaching a specific target. Once we achieve this target, then we don't care about anything else. So if a sales department manager, for example, is given an increased sales goal and as a result accept customers who are poor credit risks, the sales goals may be met, but the overall firm may suffer reduced profitability from bad debts. I don't know if you ever heard about that, but this is very common in the automobile industry and car dealerships. Sometimes they just want to achieve the targets, so the managers might start offering credit for people who cannot, or for shoppers, car shoppers who cannot really afford this kind of loan or situation similar to that. And they're just doing that because they just want to achieve the sales goals. This is very dangerous because at the very end it might negatively impact the business. So as you can see in this exhibit here, the human behavior problems in budgeting, when the budget is too high, the bar is too high here, it's hard to achieve. It's very demotivating. And when the budget goals are too loose, again, it's very easy. You can just achieve the budget without too much effort. And sometimes the budget can create this kind of conflicting goals, and this is something that we have to be careful about. Now let's talk about budgeting systems. So budgeting systems vary among companies and industries. You never find like one system that's applicable in all companies. Again, depending on the industry, depending on the history of the company, depending on competition, depending on the kind of employees that are working in the company. Many different factors can affect the kind of system that's selected or implemented within a business. A budgetary period for operating activities normally includes the fiscal year of a company. We normally set a budget for a year, and then we break it down maybe to a quarter or a monthly basis. So a year is short enough that future operations can be estimated fairly accurately, yet long enough for the future to be viewed in a broad context. For control purposes, annual budgets are usually subdivided into shorter time periods, as I just mentioned. So we can use quarters of the year, it could be months, and it could even go down to like a weekly budget. A variation of fiscal year budgeting, something called continuous budgeting, maintains a 12-month projection into the future. So it's like a moving target that keeps changing. So we drop the last month and we add an extra month or add a new month. So we call it continuous budgeting. So the 12-month budget is continually revised by replacing the data for the month just ended with the budget data for the same month in the next year. So we keep updating or adding to the budget on a monthly basis. So this is how it works. Like you see here, the entire year. Let's say we are in the month of February. It goes all the way to January. By the end of February, we just drop this budget. We delete one month and we develop it. We add a new new month for February of the next year or the following year. Of course, this is not going to be the same value. Like this should continue the trend to what we had in the budget in the previous month. So developing an annual budget usually begins several months prior to the end of the current year, with the responsibility normally assigned to a budget committee. In very few cases, you see the manager, it's a one-man show where he or she would set the budget. But normally we have a budget committee, and the budget committee would work together on setting the budget. So the committee often consists of the budget director, the controller, the treasurer, the production manager, and the sales manager. And I think this group of people would be the best to set the budget, because you have somebody who understands how to set the budget, the controller, and who's usually a financial person who's aware of the financial situation of the company. Same thing with the treasurer, the person who takes care of the accounting side of the business or the firm, and then production manager and the sales manager, because these are the managers that would handle manufacturing and the sales, and they can give us some kind of insight about their expectations for the production and for the sales. So the budget process is monitored and summarized by the accounting department, which reports to the committee. Several methods of developing budget estimates exist, including something called zero-based budgeting. I want to remember that name, zero-based budgeting, which requires managers to estimate sales, production, and other operating data as if operations are being started for the very first time. So we're starting from scratch, in other words. So that's why they call it zero-based budgeting. Is that very common? Not really. A more common approach is what's called incremental budgeting. So remember that name, incremental budgeting versus zero-based budgeting. So in incremental budgeting, it starts with last year's budget and revises it for actual results and expected changes for the coming year. Now let's compare two other forms of budget. One is called static budget, and as the name implies, it's static, it doesn't change. And then we have the flexible budget. So a static budget shows the expected results of a responsibility center for only one activity level. Once the budget has been determined, it's not changed, even if the activity changes. And by activity here, we mean like the number of production or the amount of production, the amount of sales. So if anything changes, we're still sticking to the original budget. That's different in flexible budget, because in flexible budget, activity changes has an impact on the amount that we budget. So the budget is not a fixed value. It can change depending on the activity changes. So static budgeting is used by many companies or many service companies and governmental entities, and for some functions of manufacturing companies, such as purchasing, engineering, and accounting. And one thing that this budget or static budget can be a good fit in is any kind of activities that are very stable. There are no surprises or no dramatic changes from one period to another. So a disadvantage of static budget is that they don't adjust for changes in activity levels. That's a big disadvantage. And compared to flexible budget, I think flexible budget is very helpful, and I think that's its strength when it comes to changes in or adjusting to changes in activity levels. So to see an example, assume the static budget for the assembly department of a company called Coulter Manufacturing Company, and we'll see this information in the next exhibit here. So you can see here they have direct labor or budgeted direct labor 40,000, electric power about 5,000, supervisors salaries 15,000 for a total of 60,000. So that's their assembly department budget. So assume that the assembly department of the company spent 70,800 for the year ended July 31st of year 8. In this case, remember, we had a budget of 60. So our budget here is 60,000, but we actually spent 70,800. So the assembly department spent $10,800, or about 18% more than what it was budgeted. So if we take 10,800 divided by 60,000, that's about 18%. So the first reaction is that this is bad news, and the assembly department was inefficient in spending more than budgeted. And it could be true if the activity or activities are the same as in our budget. However, assume that the assembly department budget was based on plans to assemble 8,000 units during the year. However, 10,000 units were actually assembled. So the additional 10,800 spent in excess of budget might be good news. The problem with static budget, it doesn't look at it that way. So the assembly department assembled 25% more, like 2,000 units over the 8,000 units that were actually budgeted, more than the planned, for only 18% more cost. So we got more production for lower cost, or lower additional cost, which is the 18%. And in this case, the static budget may not be useful for controlling costs, because again, you see that the activities were not stable. So let's compare that to the flexible budget. So unlike static budget, flexible budgets show the expected results of a responsibility center for several activity levels. A flexible budget is in effect a series of static budgets for different levels of activity. So how we construct it, there are a few steps that we have to follow. The first step, we identify the relevant activity levels. So we need the activity levels to be realistic. So in the previous example, we had 8,000 units. Let's say it could be 8,000, could be 9,000, could be 10,000. So we need to identify the relevant activity levels, which could be expressed in units, it could be machine hours, could be direct labor hours, or some other form of activity base. Then in this next step, we identify the fixed and variable cost components of the cost being budgeted. So we see how much is the fixed and how much is the variable cost. And then we prepare the budget for each activity level by multiplying the variable cost per unit by the activity level and then adding the monthly fixed cost. So let's see this in the following example for the same company, Coulter Manufacturing Company, and we're looking at their assembly department. So here you see in our budget we have three levels, level 1, level 2, and level 3. And we have units of production, 8,000, 9,000, and 10,000. That's the step 1. And remember, we have to try to assign realistic estimates. So here, the 8,000 to the 10,000, these are realistic estimates, but we cannot really know exactly how much we're going to produce. So the variable cost would include direct labor, which is $5 per unit, and we take the $5 multiplied by the units of production, we get $40,000, $45,000, and $50,000. We have the electric power, which is about 50 cents per unit. It can vary from 4,000 to all the way to 5,000. And then the total variable cost would be 44, 49.5, and 55,000. Then we have the fixed cost portion, and this is where we have the electric power, it's fixed amount, supervised salaries, it's fixed amount, and the total fixed cost at each one of these three levels is 16,000. And then we get the total department cost, that's the budget cost, is 60,000 for level 1, 65,500 for level 2, and 71,000 for level 3. So with a flexible budget, actual cost can be compared to the budgeted cost for actual activity. So let's assume that the assembly department spent 70,800 to produce 10,000 units. So now the actual production turned out to be 10,000 units. In the previous chart, we've seen that the assembly department was under budget by $200 because if you look at this, at a 10,000 units of production, the total department cost, the budgeted department cost would be 71,000, but we actually spent only 7,800. So we're under the budget by $200, which is good news. Remember, if we're using the static budget in the previous case, the previous scenario where we only had a fixed budget, we'll be over the budget by 10,800. Because remember, the budget was 60,000 no matter what the amount of production. And that makes the comparison not very realistic. So the flexible budget for the assembly department is much more accurate and useful than static budget because the flexible budget adjusts for changes in the level of activity. So here we see this kind of comparison. Like on the left side here, we have the static budget. It's set at 60,000. The actual results turn out to be 70,800. So we're over the budget by 10,800, even though we actually produced more than we actually had in the budget. But in the flexible budget, we had 3 levels of production, 8,000, 9,000, and 10,000. We end up producing the 10,000 for this amount, which is 70,800. And because of that, we are under the budget by $200. So in this case, I think this shows you why the flexible budget might be much better to implement in situations where production is not stable. It might be changing level of production. But if you have a stable or expected level of production, then I would say the static budget is simple, straightforward. You don't need to worry about it too much, because otherwise we will just forget about the static budget and won't use it. But in some situations it might be more realistic to use the static budget and maybe simpler to implement. So in developing budget, companies use a variety of approaches, including 2 of the most popular approaches. They can use spreadsheet software such as Excel or Microsoft Excel. It's very popular for that purpose. Or there's something called the BMP software system. It's an integrated budgeting and planning software system. So spreadsheets ease budget preparation by summarizing budget information in linked spreadsheets across the organization. The impact of proposed changes in various assumption operating alternatives can be analyzed on a spreadsheet. On the other hand, the budgeting and planning software system use online tools to link thousands of employees together during the budget process. Employees can input budget data online and that are integrated and summarized throughout the company. So again, BMP software systems could be a little bit more advanced. It can help integrate the budget by including many employees at the same time. Now let's try to test our knowledge. And we go for the knowledge check activity number 1 here. So which budgeting method starts with last year's budget and revises it for actual results and expected changes for the coming year? Is it the incremental budgeting? Sounds tempting. Flexible budgeting? Zero-based budgeting? Or continuous budgeting? It's definitely not the zero-based budgeting. Flexible budgeting is a different form of budgeting. We have different levels of budgets. In continuous budget, we drop 1 month and we add 1 month. So the right answer is incremental budgeting. So a common approach to budgeting, called incremental budgeting, starts with last year's budget and revise it for actual results and expected changes for the coming year. So let me stop here. In the next video, we're going to start talking about master budget.